Eli, we were talking with one guest earlier on the show today about the push-pull factors that we're seeing in markets globally right now. Of course, investors on the one hand looking at the vaccine rollout and execution, but then on the other hand looking at more negative headlines around the virus and the trajectory and its spread. What do you think is more important right now, and what should investors be focusing on?
I think you're right, Dan. I think over the near term, how the vaccine rollout is going to play out, and also whether we are going to see a big disruption to the reopening theme from the new viral strains that we are seeing is going to be a key narrative for markets. And I think what's conducive and what's instructive for investors here is to really step back and look at the dynamics of the whole business cycle here. We are really just in the early innings of the post-pandemic bull market and a multi-year new business cycle. And history tells us that this is a very positive part of the business cycle to stay invested in. And finally, I would say that there's still a lot of skepticism out there. Really, if you look at the VIX index trading at above 20, I think it's hard to make a strong case that there is complacency in the market. And I do think that this rally is sustainable, and over a 12 to 24-month horizon, there is more upside to come.
So Eli, if we are at the start of a post-pandemic bull market, why do we have top market commentators saying that there are risks building out there, that equity valuations are looking stretched, that growth and the outlook is looking unsustainable from this point on? Why do you think that that's the case then? Are we going to see upside? And if so, can you put a percentage on it for the markets that you look at?
All right. Well, I think that with the very sharp V-shaped rally that we saw since March of 2020, the market has really surprised a lot of people, and I think it is natural for most people to think that some sort of peak must be building in. But I do think that we have to look at valuations against the fact that interest rates are very, very low, especially against the fact that real yields are very low. So, as you know, equity cash flows are set aside competing assets, such as government bonds and cash. And with cash yielding next to nothing and government bonds in some developed markets giving you almost negative yield, it does make sense for valuations in the equity space, if you look at price to earning ratios, to be trading at a higher range. Therefore, I do think that this continues to be a market that's going to climb a wall of worry. Now, of course, it's not going to be smooth sailing all the way with regards to the recovery. There's going to be some ebb and flow. We might see a near-term consolidation. Again, historically, we see a 10% correction in markets every 1.5 years. So it is hard to predict these short-term corrections with much certainty. But I do think that by and large, investors should stay engaged with the markets. And as I said, I think the long-term outlook continues to look constructive.